All right, sometimes there's visionaries, you don't want to mess with them. It's been a very tough year for the battered oil and gas industry. Oil got crushed today. Even before the pandemic, we started getting the sense that corporate America suddenly cared about fighting climate change. Then we entered the corona economy and demand fell off a cliff. For years, the industry's been weighed down by excess supply. Every time prices rise, some producers turns the spigot back on, prices come back down. But now, I think we're finally starting to see bankruptcies, more importantly, mergers like Pioneer buying Parsley. We're hearing chatter that this could kick off a wave of consolidation. On the other hand, COVID cases are exploding again. Europe is going back into lockdown, and you have to expect some partial shutdowns here. It's not great for energy demand. At uncertain times like these, what do we need to do? We got to go to smart people. We got to go to experts. We go to veteran operators who understand the industry. We go to Sharif Souki, the liquefied natural gas pioneer, who's currently executive chairman of Tellurian, to see if he can shed some light on the subject. Mr. Souki, welcome back to Mad Money.
Hey, Jim, how are you?
Well, you know what? I'm in touch with you, so I'm good. Not that long ago, when I was bashing natural gas, you sent me a little email saying that I'm going to be wrong and it's going to go higher. I immediately shot back, I don't think so. It has done nothing but go up since you sent me that email. Where can natural gas go and why?
Well, to start with, Jim, we're drilling only with 75 rigs in the United States. Actually, as of today, it's down to 72. And in order to keep production flat in the U.S., we need 200 rigs to be operating. So we're losing about a BCF a day of production every month. We started the year at 95 BCF a day. We're now down to 88. And at the same time, on the demand side, demand has been remarkably stable in spite of COVID, with the exception that we're now exporting more LNG than we did last year. So we have a net delta of about 10 BCF a day every day. We started this week to withdraw from storage about 2 weeks earlier than normal. This is going to continue to accelerate through the winter. And what it's going to take is higher prices to do one of two things: either increase production or destroy demand. So increasing production takes time. We're not going to go from 75 rigs to 200 overnight. It's going to take at least a year and a half or 2 years to get there. So we're going to be in serious deficit this winter. We will have to destroy demand. We can do that one of two ways. We can switch back to coal,
right,
which
we're not going to do.
Well, you don't know, because all the utilities have a ton of inventory, of coal inventory sitting there, and the prices are justifying starting to switch back. It'll happen in the summer, because right now power generation is not very important. But if we don't do something about it, then we will switch back to coal.
But Sharif, I mean, you're describing... how about the Marcellus? We're producing a huge amount there. How about Canadian natural gas? How about China not using our natural gas? Does Korea really need our natural gas? This is an alternative universe from what I thought was supposed to happen.
Okay, first, the Marcellus has plenty of gas, but the prices on the Marcellus are very low because we don't have enough pipelines to take the gas to market. So the Marcellus is restricted by the infrastructure. The Haynesville is very attractive right now and is increasing modestly, but not much. And if you look at all the gas players today, they are hedged for the next 12 months because of their financial situations. Therefore, higher prices is not going to benefit them immediately.
But the geniuses at Exxon were talking about taking a write-down of 25 to 30 billion, mostly related to XTO. I mean, are they on the other? They bought that when natural gas was at $9. So maybe now that they're writing it off, maybe they're kind of wrong on both ways.
Well, at this point, I think they have to do what they have to do is survive for the next year or so. But prices will bail them out as always. So first, we're going to have a reaction in gas prices. And that will happen this winter. We've already started to see
Why
this.
are you the only person who's talking like this? Because you're the only person who ever thought we'd export liquefied natural gas. So,
well, Jim, you know me. I look at the numbers and I try not to get emotional about it. So for me, if we need, we were producing 95 BCF a day. We're quickly on our way to 85. So we lost 10 BCF of production. We need to get it back.
Well, but maybe we shouldn't be. Is it going to be? Should we not be exporting as much as we are?
Okay, so this is a very hard thing to do because now we are dictating prices around the world. The market is completely connected now. The US is 20% of the LNG market. So the rest of the world, if we want to do business with China and India and Asia and Europe in the future, we have to be reliable trading partners. And if we don't sell them our natural gas, we're not going to be reliable trading partners. So you've seen in the last few weeks, couple of months, JKM prices in Asia and TTF prices in Europe go up when Henry Hub was going up.
Wow.
The world is getting correlated, and we're dictating the pace.
What happens if Biden wins for president and not that good, doesn't really support fracking the way that, say, the current president does?
I don't think it'll make a difference because reality is reality. I mean, I think slogans during election day campaigns are one thing, but at the end of the day, you have to deal with reality. We are going to do business with China. We are going to do business with India. In India, LNG demand is up 20% year to date. In China, it's up 8% year to date. Even in Europe, it's up 9% year to date.
So you were right and they were wrong. Everyone had told me that these contracts would be canceled and nobody needs the natural gas. They were all wrong, aren't they?
Well, first, I wrote most of the contracts. They cannot be canceled.
Right.
So the second thing is the business model that we created at Cheniere a few years ago is no longer valid. It is now a true commodity, and being dependent on a price index as volatile as Henry Hub is not practical.
Okay.
You cannot, as the buyer of LNG on a global basis, be reliant on an index that can be as low as $2 and as high as $5 or $6, as we're going to see this winter. You have to come up with a different business model.
All right, well, look, we got to wrap things up, but you're going to come on and explain how we should do it, okay? Because you were dead right. I can't believe how right you've been. Well, you tell the truth and you're not owned by anybody. Maybe that's what makes the difference. That's Sharif Suki, executive chairman of Tellurian. And by the way, right on natural gas and right on oil since we started the darn show. Mad Money's back into the break.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.